Money Show.
Personal Finance with Warren Ingram.
Personal Finance brought to you by Liberty, your financial partner on however and whenever you picture retirement. You can live it your way. Hashtag in it with you. Liberty Group is an authorised FSP. T's and C's apply. The struggle to stay awake through this one, Warren Ingram. ESG. This is the boring, worthy stuff of investing, isn't it?
Boring, and I think hardly. I think it's the kind of the cutting edge of what's going on in the investment world, and it's kind of, to me, it feels like the first time where investors are able to put their money where their values are. You know, for so long, investors would be saying, I'd like to get capital growth on my money. I'd like to invest and build wealth. But I don't really want to be polluting the planet or, supporting companies that, that use child labor or, have gender inequality in the way that they pay their staff or, discrimination of any kind. So it's always been the sense of discomfort for investors who have a wider conscience. And over time, this ESG theme has gathered more and more momentum. And there's always been this sense from the kind of grumpy, older people in the industry of the asset management industry that, if you invest according to your values, it's going to cost you money. You're going to sacrifice growth. And we're not seeing that. The numbers are telling a very different story. It seems like, you can have your cake and eat it and make the world a better place all at the same time.
It's so important that finally I think we've realized that you cannot keep extracting value from the limited resources that the world has to offer. You cannot keep digging holes in the ground and filling them with chemicals and expecting them to sort of naturally sort themselves out. There are complications, and that's why ESG, which stands for Environment, Social, Governance, right? Am I being a good boy and getting a pat on the head here?
Spot on. You 10 out of 10. And I think the interesting thing about ESG investing, and especially more so around the companies that are actually managing their businesses on a sustainable basis, when you look at those businesses and you look at the decisions that they're making, they naturally have to look at their companies and judge performance over a longer period of time. And it's one of the things that's really worried me, as an investor in companies, is especially if you look at American businesses. CEOs there report the growth of their businesses on a 3-monthly basis, on a quarterly basis, and so every quarter that they've got to deliver numbers and they've got to show analysts that they're doing something, that the business is going in the right direction. And what that does is it suddenly brings the timeframes to such a short-term focus that I think they've made a lot of decisions, often that are actually very poor for the long-term health and well-being of the company on a financial basis. So when you look at a CEO who says, hang on, we're going to build a sustainable company that operates in a sustainable ecosystem of businesses, both suppliers and clients, we're going to do things that environmentally are good, and we're just going to take a much better holistic view of our business. It automatically means that they're looking at things on a long-term basis. And if you look at listed companies that do well over long periods of time, it's fascinating how often the CEOs of those companies and the management teams have stayed in place for a long time. And secondly, that really have a long-term focus. Warren Buffett's, he's not a great example of an ESG investor, unfortunately, but he is an example of a CEO who looks decades ahead and then makes decisions, now that should reap benefits for shareholders over a long period of time. And that's the thing that's really exciting for me about ESG investing is I think we have the opportunity now to invest in high quality companies with a long-term focus and make the world a better place. I mean, it just sounds like it's too good to be true.
No, but it does. And I'm wondering whether or not there's any data which supports the fact that actually this is a decent investment strategy. I mean, yes, we should be doing it from a sustainability point of view. Yes, we should be doing this for the planet. Yes, we should be doing this for our children and grandchildren and everybody else who comes after them. What, however, doesn't help is if we make these investments with bleeding hearts and feel so good about ourselves, but the returns are rubbish. I think there's an increasing amount of data which suggests that companies that operate in a way that is good for the environment, good for the social environment, and do so with good governance principles, ultimately, and I don't know if this happens in the short term, but ultimately will outperform, or at least they should.
You're 100% right, Bruce. I mean, I think the two big global, ratings agencies around fund managers, is the one is S&P, Standard & Poor's, and the other is Morningstar. They deliver quality research. And what I like about, talking about their numbers is they're not trying to sell an angle. They monitor everything. So they don't particularly care whether, it's the fossil fuel companies that are doing better or the ESG companies. They just need to monitor the stuff and give us something that we can use for information. And so when you look at someone like, Standard & Poor's, on a global basis, they're looking at these ESG funds. And, interesting in a lousy year like last year was for a lot of big fund managers, and you look at what did the large ESG investments do? And, if you take a universe of somewhere around 40 of them, only 6 didn't do better than the market. So that's an astonishing number. We know time and time again, we talk about how many fund managers can't beat the index. And here we've got, something like 34, ESG funds, smashing the index in some instances by almost double the return. And only 6 underperforming, and not one of those lost money. And sure, last year probably no good funds lost money, but the point is that you're starting to get returns consistently higher than the index, and doing good. I think that the investment thesis is real, and if we look at the amount of money that's flowing into ESG funds, it's going up by 10 times over a 2 or 3 year period. And we know that, when you see a major trend like that, the last time we saw a trend like that was the rise of index investing. When investors started to move away from fund managers to index investments, this kind of theme, unfolded. And I think we're seeing it now. We're live in a sea change of the whole asset management industry, and it's a critical one to watch.
But you're not getting companies that are having to fight with regulators. You're not getting companies that are having to fight with their own shareholders. You're not getting companies that are ending up having to pay massive fines for destroying the environment. You're not having distracted companies. You've got very focused companies that are acting with absolutely clear purpose. And I think maybe that's where the difference comes in, because of that absolute focus they have on ensuring that their businesses are run properly. Well, I want to move on to Celeste's question this evening, and we'll do that in a moment. It's a long question, but she wrote it to me personally, so I'm quite enamored with Celeste. I like to think I'm smart with money, but after recently starting to listen to podcasts of personal finance with Warren Ingram, you get a mention too, I'm starting to doubt it. I would love it if you could feature my question, which we're going to do. I'm very risk averse. So what I've done is saved up money into a 32-day notice account with low interest rates. When it reached 60,000, I took it out and I invested it into RSA retail savings bond account over 5 years with an interest rate of 9.25%. I'm about halfway through that term now. I'm repeating the same process now, saving up to 500 Rand a month. And when the retail bond matures, my plan is to take the savings plus the retail bond money and put it back into the RSA retail bond account for another 5 years, repeating the process. This is to save for my kids' future car university fees. For another 8 years or so until I need the money. If saving this way isn't a good idea, I would like you, or Warren, I'll make it Warren's problem, to explain to me how I can get better returns. I'm also saving 4,200 Rand into my retirement annuity. I'm paying too much in fees, so I'm moving to another provider. On top of that, 2,400 into an endowment policy, which I might as well leave as it is, for a tax-free savings account. This person, Celeste, is almost like this perfect human being. I've trimmed my expenses as low as they can do to maximize my savings pool. But somehow, I'm still doubting if it'll be enough for retirement if I don't do the right thing now. What a great question. I'm going to email this to you quickly, Warren, so you can get a bit more of the detail, because it's very meaty and chunky. But Celeste is doing a lot of different things, and I think that Celeste is doing a lot of things right. Can we help her do it better? In a moment.
The Money Show.
Personal Finance with Warren Ingram.
So Warren has been speed reading, and Celeste's email is very long, and she's doing lots of different things. Money into 32-day savings accounts, money into RSA retail savings bonds, money into a retirement annuity, money into an endowment policy, money into a tax-free savings account, which goes into ETFs. And I mean, just there's a lot of good stuff in here. Is she doing anything wrong? Could she be doing things better, Warren?
It's The answer is that Celeste is doing a lot right, and it's it's always easy to find fault in what people do. And I think the thing about money is if there is many different ways to manage money as there are people, I think. And so I think just to touch on a few points, the first thing I looked at was what are the interest rates on the RSA retail bonds when Celeste's current fixed deposits and current bonds mature, because that's going to be the trick, is what are the future rates going to be. And at the moment they're paying 8.25% a year, and depending on what your sort of personal inflation rate is, we know that we're in a low inflation rate environment at the moment. So to get a return of a guaranteed return of nearly double the inflation rate is not something you should just disregard if you're a low-risk investor. And I think that's the point that Celeste is making a few times in her questions, is she doesn't like risk. She is risk-averse. And so, my financial planning textbook would tell me that you can't put all your money in fixed deposits for periods of 5 to 8 years like Celeste wants to do, because you can get better returns from the JSE and from all stock markets around the world than you can from fixed deposits. The problem is that those returns come with an element of risk. So looking at the return of 8.25% per year for 5 years, if you put it into the retail savings bonds now, that's a good return. We need to acknowledge it. My concern for Celeste is how much tax she pays at the moment, because all of this will be income tax, and so there will be a portion that the taxman allows us to earn interest free every year. But if Celeste earns does pay a lot of tax, it's possible she gives up nearly half of this as tax, and that's a painful way to lose money. So I think if Celeste is a very low taxpayer and she doesn't like risk at all, then doing what she's doing now, despite what my textbook says, is probably a good strategy for Celeste. If it was someone else who said to me, I've got 5 to 8 years to invest and I can tolerate some stock market growth and some stock market volatility, the rising and the falling, then I would say to her, go into a balanced portfolio. In the unit trust world, they're called balanced funds, where you've got sort of 2/3 in shares and the balance in cash and government bonds, where you should get somewhere around 8 to 10% a year, and most of that won't be taxed. And that's the big difference here. So beyond that, Celeste is doing well. I hate the fact that she's got a tax freeze in savings accounts and fixed deposits. They need to be in exchange traded funds. And definitely the mix that she's talking about with half in the top 40 index in South Africa, half in the world index, makes all the sense in the world. So that you should definitely do, Celeste. But the fixed deposits, I'm not convinced. I think I'd probably go into balanced funds.
Thank you, Warren. I think that's a very clear and concise answer to a very long and comprehensive question, Celeste. You are a superstar. Well done. And Warren hopefully has just helped you refine your portfolio just a little bit. I've trimmed down my expenses. This is a woman after your own heart, Warren, so that I can maximize my savings pool. And I think doubt in the investment process is important. You shouldn't have so much doubt so as to sort of debilitate yourself. But to be constantly challenging and questioning and making sure that you're on the right track surely is a good thing, right?
It is, and I think I'm as you said, I'm speed reading. So one of the things to just to touch on as well is looking at Celeste's question around her retirement annuity. The thing about retirement annuities, they get a lousy reputation because some of them are offered by insurance companies and product providers that charge really high fees, and so those fantastically high fees unfortunately destroy the growth. So I would say the structure of retirement annuities are actually very good. The benefits we get are excellent, but you need to be in a very low cost retirement annuity. And that means look for investment companies, look for exchange traded fund companies where the costs are low. And then by all means, you should keep contributing to your retirement annuity. And it's a great call. Your endowment policy, I'm not a big fan in general because of the fees. So watch out for that. Be careful of the costs. And I think that's what makes me happy about Celeste. She's listening to our podcasts, learning the lessons, and adapting her investment strategy along the way. And well done to you, Celeste. It's amazing.
Okay, fabulous. Thumbs up from Warren Ingram this evening. Finally, just give me a sense of a phrase, a word, a term, and perhaps it fits in nicely with what Celeste is asking here. What is this idea of asset allocation.
Yep, another piece of jargon from our beloved industry. So asset allocation is getting the combination of cash, bonds, property, and shares. So that mix and adapting that mix for each of us as investors or per fund or per investment is called asset allocation. And so it's probably the most important investment decision that anybody needs to make. It's far more important to get the mix of your cash and your bonds and your property and your shares right than it is to say, let me choose, what shares to buy and what bonds to buy. I think we spend so much time as an industry on the stock picking or the bond picking and those kinds of things, and actually not focusing on the asset allocation. And so for an investor, someone listening to this podcast who says, where can I spend the most efficient time for managing my money? Get your asset allocation right, and you'll solve a lot of the big financial problems that a lot of people have, because they just get this completely wrong. They're so focused on the wrong issues here and missing out on the really big picture. Big picture is asset allocation. You get that right, you solve the investment problem. You get it wrong, and unfortunately, you destroy the value of your money.
Warren Ingram from Galileo Capital this evening on a Thursday night. Thank you, Warren Ingram.